After a pretty monumental, pretty eventful week last week with a lot of news on the docket from earnings to jobs to FOMC. We start off still a pretty decent earnings week, but a relatively quiet week with a really quiet day today. Considering how bullish we were in the last few days, especially considering how much some of these markets moved on Friday outside of the stock market, other markets moved. You saw a continuation of those moves today, and it didn't have quite the bullish effect on equities today as it did, especially in the small cap index. So we're going to take a look at some of these patterns developing across these major indexes, especially as we see things like yields move higher and interest rate cut odds move lower. That was probably the biggest driver today. You'll see that. I'll show you some patterns, especially how those are impacting equities, what our expectations are for stocks, especially the Russell 2000, which is showing us some early stage signs of weakness. And you can see that in how the sectors are performing as well. And then we'll take a look at a stock that's actually in the technology sector that really broke down today. And we'll talk about how to trade that considering the market environment. So let's go ahead and get started. Today is Monday, February the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I review the trades from other Market Outlook videos to see whether we should stay in them or get out of them. Come down to the bottom, click this heart, it opens up this tab. Hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. That's a big deal for us. That's why we always ask. So thank you to those who like these day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You see we dropped today, but not very much. Came off of the lows at kind of in the middle of the day today. The intermediate line did cross slightly below the market sentiment line. They're both falling, but again, they're both in the reversal zone, so it's hardly bearish. The near-term line is in bullish territory, and so far is peaking at a bearish level, and it would be a divergent level because it would be a lower high point with a higher high, and again bearish because it would be peaking at right at 80 instead of well into the reversal zone. Remember the peak. The top of the bearish range is 80 and the bottom of the bearish range is down to 0. The bottom of the bullish range is 20 and the top is all the way up, obviously to 100 above 90. So like these are bullish peaks, these three bullish peaks in the near term line. This one obviously would be bearish, especially bearish because of the divergence that you're getting as of right now at the price. But you're still easily 2.5% above the moving average, so it's hardly a concern right now. Looking at the Dow Jones Industrial Average, it was down a little bit more coming off of the cluster on Friday. Again, same kind of divergence there, lower highs with higher highs on the index itself, and you can see short-term sentiment declining. The market sentiment's down below market sentiment, but market sentiment's above the 90th percentile, so it's pretty darn bullish. But they're both falling inside of bullish territory, so we'll see how that plays out. And then your NASDAQ 100 did not come down very much at all, thanks to NVIDIA. And you can see the near-term line actually crossed up above the intermediate line. The intermediate line is still below market sentiment, but at least they're both rising in this case. So you have dark green shading and a green line. The near-term line is still rising, like I said. And then finally, your Russell 2000. You can see, again, dark pink shading and a red line for another day. And it was down over 1% today. The intermediate line's in bearish territory as it is. I mean, you're in a bearish intermediate decline. You're below that 20% retracement, 23% retracement of this bullish rally again, because we never did get a new bullish rally. So, like, we're retracing already. And it's like such a distinct market between the Russell, which is more reflective of Main Street, so to speak, and then the NASDAQ 100, S&P 500, which is more reflective, obviously, of what's going on with those mega cap names. Different ones taking turns as to which one is having the biggest influence so far on the rest of the markets. If you take a look at the weekly chart, For the S&P 500, you can see another bullish week. We're just getting bullish week after bullish week. You're only that one bearish week where we were barely below zero there. This is the size. This is the body of the size of the body of the candle up there. And so when you're below zero, that means it's red. So you were barely red, but it was. And now you're below the moving average this week. You're still bullish. You still have a higher close. You don't have a higher high, but you have a higher close so far, one day into the week. And you are below the moving average, so we'll see how that ends up playing out. Of course, the Russell 2000 looks different because you actually do have a bearish candle and you have a red arrow, so that means you're below the 10-week moving average, and your PPO is falling, right? It's still pretty high, but it's rolled over with a pretty, obviously below the moving average on that Hakinyashi differential down there as well. Looking at the 3 green arrow charts. You can see we still have 3 green arrows on the S&P. We still have 3 green arrows on the Dow. We do not on the Qs because of the MACD is still negative. And you have 3 red arrows and a red line on the Russell. So, the Russell is an intermediate decline. Very beginning stages. So it's not like we're like tanking here, but still it's in a bearish intermediate decline. And all these other, you're still 3 green arrows and moving up to the upside and everything else. You can see that on the 2-line version of the chart as well. The S&P is all the moving averages. They're all in order. Price 8, 17, 30, 50, 200. Very, very bullish. MACD is above its moving average. Stochastics is not, but at least it's in bullish territory. The upper reversal zone at least. You look at IWM, different story. You're flirting with breaking the 50-day moving average. In fact, you actually did. You were a lot further below it at the lows, but you're still ended up below it. The MACD is negative, below its moving average, and it's negative. It's below zero, barely, but it's below zero. And stochastics, of course, peaking at a bearish peak, just like that near-term line I told you, and is out of bullish territory now, dropping out of bullish territory. Looking at some of these other oscillators here, you can see the S&P 500. Again, you're still pretty bullish. You're still above 30, below 20 on the positive and negative indicators, so your ADX is still strong. That looks good. IWM, on the other hand, they're both below 25, but the positive is actually below 20. So for it to get below 20 is a pretty big deal. That's a sign of again, bearishness. It doesn't get below 20 very much when you're in a bullish trend. And it does get below 20 when you have a change in trend. Your positive is not above 25 yet, so we'll see. It's got to get above 30 really to get the ADX rising. The ADX down there below 20. So you see, again, very beginning. If we are in a bearish trend, we're in the very, very beginning stages. You can see that same divergence on the RSI and, for that matter, the CCI as well. But at least they're both still at bullish levels. Again, not the case for the Russell 2000. Well below zero, below 50. So again, they're in that kind of, they're in bearish territory, but they're not. They need to be confirmed by a break below 40 and a break below at least minus 150. And then you can see more of a decline here, at least below zero, if not below minus 100. To turn bearish on this one. Of course, on the weekly chart, your S&P 500 is still above 100 on that weekly, and your RSI is still actually above 70. So again, hardly bearish at all on those indicators there. Looking at the Ichimoku cloud, very strong trend on the S&P 500. Not so much on the Russell, right? No trend at all. You're into the cloud now for the first time. Obviously, you have a very strong negative rate of change. Your green line's below the blue line. Again, that's typically a reversal sign when the green line gets below the blue line. So here we are, right? That's we're in the early stages. Your Bollinger bandwidth, we're still in the upper quartile of the bandwidth. So we're still strongly bullish. We're still outside the Keltner channel, and you still have pretty decent bullish momentum, though it's kind of turned down slightly there. If you look at IWM. Different story, right? We're in the lowest quartile of the bandwidth, and the bandwidth's really small, so potentially turning up. You've had negative momentum, it turned positive, and now it's turning back down to potentially being negative as the bands are well inside the Keltner channel, and we'll see if we end up going down further. So again, early stages, nothing too imminent, like a major decline or anything. You did not get a new high today on the S&P 500. So your rune indicator, after already hitting zero on the red line, is dropping down. It's got to take 6 days for it to get below 70 when you start to worry about a change in direction. And really, it's going to take more than a week before the low point starts to ramp up. Again, not the case in IWM. It is in the lower half of its 4-week range, and you can see it is a lot closer to a new 4-week low point because it's, again, you got a one touch. Remember, these are bearish. You got a one touch on the green line. It didn't even get to 100, and then now you're almost back below 70 as the red line is falling, and your bandwidth is really falling from where it was. So, things are looking like we're headed south on the Russell 2000 a lot more than we are on the other indexes. I remember the volume and the trading range dropped down below average after 3 straight days above it, and a very small range too below average again after 3 straight days above it. And those 3 straight days still are influencing the average, the normalized ATR higher, not back above 1% yet. Again, that's kind of when you're bearish, is when you get back above 1%. And you can see the volume is still kind of tapering. It's not turning higher yet either. We'll see if that ends up turning higher or not. Then finally, your VIX, not surprising, will jump up at the beginning of a Monday, but fell down and actually got below Friday's low point at the end of the day. So easily back below 90%. The VVIX is back below 80, so back to extreme lows. So both the VIX and the VVIX, well, the VIX isn't necessarily at extreme lows, but it's at a low point. The VVIX is back to an extreme low below 80. And you can see here, sorry, let's go to the 2-line versions. Again, it's going to be hard for the VIX to go down too significantly here because it's actually above these averages, right? Even coming down, you're still above the 17 and the 30, and you're still relatively bullish. So, and you're still kind of converging here with the ATR still extremely low. The ATR of the VIX I showed you on Friday is still just extremely low there at 7%. So we are due for a tsunami, right? That's the Andrew Thrasher's paper on the VIX, award-winning, Charles Dow award-winning paper on the VIX, trying to forecast a volatility tsunami. And that's kind of the idea, is like not exactly, but the idea is the more that the range of volatility compresses, the more likely you are to get, a tsunami, like a big move higher, because those big moves on the VIX come out of nowhere, as you see here when you look at it on a options expiration basis. The moves come out of nowhere. See, you just generally only have like one expiration cycle that jumps up, and that's really it, right? Maybe 2 out of 3 like it was there, maybe a couple in a row there, but it's really just one expiration cycle that makes a big move up, and then we come down. There's a couple there, there's a few there, but it's generally just one. And so it comes out of nowhere, and it doesn't last for very long. It makes its mark, and then we start coming back the rest of the time. And so when do these big jumps happen? We don't know, but one thing we do know is they generally happen after volatility is compressed. And you can see the last couple of expiration cycles, the range of the VIX was only 2.5 points there, 3 points there, after 9 points, after 8 points. The average range for the VIX is up 7 or over 8, and we've had just very, very small ranges, and we're a week away from this one ending, and we've only had less than 3. So we've had 3 straight months of just hardly any range at all. And again, that's the typical setup for these 1-month spikes that we see. In this case, probably only get us up to around 20, 25-ish would be most likely the scenario there. All right, if you take a look at what's driving this price action, you can see the returns over the past 3 months, but that's not then the case the past 2 days. Really coming off of that strong employment report on Friday, continuing today, the big strong move in yields. If you take a look at bond prices, TLT looked down 2%, TLT was. Real estate down as well. Like I said, IWM was down 1%. Commodities were up, the dollar was up. That's your 3-headed monster there. That weighs on risk appetite. And if you take a look at some of these charts, you can see the breadth was really bad today, minus 45 on the McClellan oscillator. We'll come back to that in just a second. But if you take a look at some of these charts, let's look at TLT first. TLT really breaking down hard below all these moving averages, now sitting right at that point of control, as TNX has broken up above its 200-day average, now up to 4.16%. Big jump higher. Of course, that's a reflection that interest rate cut odds are dropping. If we take a look at the interest rate cut odds here, let's go to FOMC. you'll see that the odds for a March cut are down to 15% now. Remember, they were just a little bit ago, they were at like 100% or 90%, 91%, and now they're at 15. So this is actually up to 85 today. So that's a big change in sentiment there. And of course, May, are we going to get a cut in May? Well, now the odds of no cut in May are at 37%, and that's a big change because just a while ago it wasn't very high. You can see this is the odds of no cut in May, and you can see just a few days ago it was at 95%, and now it's up to now it's down, to 60 some odd percent. So things are changing pretty rapidly in terms of when we're going to get that first cut. As a result, as you saw, even the 3-month yield is up, back up to 5.41%. It's a pretty decent move for the 3-month, which hasn't been moving very much at all. Then you look at like the 2-year and the 10-year. As you saw, the 10-year was up to 4.16 today at the close. But then if you look at the 2-year, it's up to 4.45%. Working its way back up. That's a new high, 4.45% above these other peaks earlier in the year. So it's making its way back up to levels that we saw when the markets weren't nearly as bullish and the Fed was pricing in those cuts. As a result of this move higher, you can see the spread is right around 31 basis points. It's dropping back down again. If you take a look at the spread of the 10-year and the 3-month T-bill, which was way low, was down to 150 basis points a few days ago, is now up to 127 basis points. So this is really starting to rocket higher as the 10-year ramps up and catches up. Now this can go, it got all the way up to 50 basis points, negative 50 basis points. I don't think it can get above zero before the Fed starts cutting rates. But as this does move higher, and if the Fed does start cutting rates, then it will drop. The 3-month will drop a lot faster than the 10-year will, and of course that will normalize the curve. And that generally stocks don't do so well when the yield curve is starting to normalize from in this case, extremely inverted situation here. The other big factor in today's move is what's going on is with commodities, as you saw with crude oil. Had really dropped last week, big down week, but starting to base right around the low 70s, right around that point of control, the DBC, kind of doing the same thing. It's coming back down to these calendar year lows. Really big decline yesterday, but then bouncing up today, despite the fact that the dollar also rallied higher today. Look at that breakout pattern, breaking up above these highs now, easily above the 50-day. Now the 30 is about to cross the 50, and it's really moving higher here. And again, that's that triumvirate there of rising dollar, rising yields, rising commodity prices all puts pressure on risk appetite in general, has for the last couple of years. And we'll see if that ends up being the case again. How prolonged this move, because if you look at like the weekly charts, this move is just starting, right? We're just barely getting above the 30-week moving average. We're just starting here, and you're already above the 200, and you're already above the 50. So we would just be getting going on that one. We're just getting going on the 10-year rising, because it's not even above its 17-week yet, and of course your DBC is coming down to the 200-week, and probably wouldn't break that 200-week unless we were in recession, right? Because that's generally what it takes, is the markets, the economy really slowing down for commodities to get into its own bear market. Let's take a look at how I want to take a look at the breadth. I showed you the McClellan oscillator and how bad that's looking here. Big decline on the McClellan oscillator down to minus 45. As you can see, we're still at elevated levels, but still kind of turning lower. If you look at the money flow, which is another thing that we look at here, you can see the money flow again had peaked barely at the same level that we were at the end of the year, but the money flow index is diverging to the downside there. So something to kind of the same idea. Divergence there would be bearish if that ends up playing out. The other thing we look at is the number of stocks above the 200-day moving average relative to the number of stocks above the 50. I had already mentioned that we broke above 1. We're above the moving average. It's bearish when we're in this scenario. The number of stocks above their 50 is really declining. It's now below 30 or 300 now, so that's below 60%. So we're not in bullish territory anymore. The 200 is dropping too, just not to the same speed. That's why your ratio is jumping up so much. And then the new highs and new lows are back to negative levels. So again, early stages, right? I mean, it's early enough that we could just bounce right off of this and be fine. But I told you before that a lot of these things, like I said, this ratio, when it gets above 1, when it gets above its moving average, are typically bearish, and it wasn't the case. And then when it gets above 1, it's typically bearish, and again, that hasn't been the case. So we've continued to rise in this environment, a breadth environment where we typically are bearish, and we'll see if that, ultimately how that impacts a risk appetite. As the Qs relative to IWM again closed at its second highest level ever on this, in the last 20 plus years. So very extreme high points here as the correlation with the S&P is continuing to get less and less negative and turn positive back to its normal. Remember, its normal correlation here is actually, if I were to go to a weekly chart, its normal correlation is actually bullish. When you look at you can see the normal correlation here is very strongly bullish. So it's getting back up to its normal level. And again, if it's already at an extreme high, last time we got to this peak, that ended up being the peak. But as we fell, the stock market rallied, and we ended up with a negative correlation. I don't think that would be the case again this next go around, unless again the bearish triumvirate of we start getting falling yields again, and falling dollar and falling commodity prices. But considering how close we are to that 200-week moving average, it's going to be hard for commodity prices to really fall significantly, again, without us already turning into some kind of economic weakness, which obviously we don't have, and nor are we forecasted to have in this upcoming quarter. All right, and that brings us to our trade idea of the day, and it's on DocuSign. You can see DocuSign is breaking below its moving average. This is actually the money flow for DocuSign, but let's go to the actual market forecast chart here. Big breakdown, breaking below the midpoint of the chart. Still not in bearish territory yet on the intermediate line, but you are almost 11% below the moving average. You got dark pink shading and a red line for the first day. Bearish short-term sentiment. You can see the weekly chart has just turned bearish. So again, kind of just starting. Like you just turned bearish. You just got a red arrow. The PPO is just turning lower. You got a pretty decently strong bearish move that has the potential to start a new run here. Obviously, you have 3 red arrows as you're below that moving average there. The MACD is not only below its moving average, but it's below 0 and really dropping sharply. Same thing with the stochastics getting into bearish territory, some pretty decent volume, breaking the 50-day moving average and the point of control. So a significant change in sentiment here. The DMI was already, the ADX is already pretty high as it was barely below 40. But now you're back above 30 and below 20 on the positive indicator. So you've really changed sentiment in an environment where you get big moves, according to what the DMI is telling us there. We're breaking below 40, well below minus 200. Big change in sentiment there. If you're looking at the weekly version of this, you haven't even broken 0 yet on the weekly CCI, nor have you broken 50 yet on the RSI. So again, you would think, you'd be in relatively early stages of any kind of decline. Doesn't mean you have to go down every day, but it does mean that there might be some more downward move to this as you are now below into the cloud. The green line's crossing below the blue line. You got a very negative rate of change, and you have the beginning of a weak bearish trend there. And then finally looking at the Keltner channel here, you can see you broke below the lower band, barely, but you broke below lower band, and you broke below lower Keltner channel, and your momentum hasn't even turned negative yet, right? It's still slightly positive. So, and you got green dots, and they most likely will stay green, but we should probably be turning negative in its momentum here as we're finally breaking out. So there's some opportunity to the downside. So what I decided to do was to do this long call vertical spread, or long put vertical spread. So buy, not buy the at the money, but 1 strike away, sell the strike ahead of that. So it sets up this risk profile for about a 2.5 to 1 reward to risk ratio. And then that's how much flexibility you have to March expiration. So if the stock goes up, that's how much it can go up before, my max gain is now unfeasible. But you can see I got a pretty decent reward to risk ratio and a pretty decent opportunity. All it's got to do is get below this 48 level, 47 and a half or so, and the one standard deviation is all the way to 42. So there's an opportunity here to really get a pretty decent reward for a very small amount of risk on this directional trade. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.